We have a bull and a bear here to weigh in. Jeffrey Sott is Chief Investment Strategist with Raymond James. He's a bull on stocks, and Tom Lydon is President of Global Trends Investment and a bear. Jeffrey, great to see both of you, by the way. Jeffrey, you just turned bullish. So let me ask you, do you think this rally that we saw last week has some real legs? And if so, what makes you so convinced?
I think that the low that we made at 666, whether it turns out to be a rally in a bear market or the start of a new secular uptrend, remains to be seen. But I think you're going to get a rally off that undercut low that we talked about that will look very similar to the rally that came off of the November 20th low. And then you'll have to see if it's going to extend or not. But I think you've got 5 or 6 weeks ahead of you that you should favor the upside.
So you're looking here on a short-term basis, an opportunity, you think, to maybe make some money, Jeffrey?
Yeah, on a trading basis, but I do think there's a 50-50 chance that you put in the low.
The low? You don't think we've already put it in?
No, that's what I'm saying. I think there's a 50-50 chance that 666...
That's it?
That was it.
All right. Well, that would be good to see. I think your other guest here, our other guest, disagrees with you on that. Our bear for us today, Jeffrey, or rather Tom, President of Global Trends Investments, our bear today. What do you say?
Well, I hope that Jeff's demonic low of 666 holds, but the bottom line is consumers need to have confidence. And I'm not sure if you saw the recent poll today, but 9 out of 10 Americans feel that we're not getting out of this recession anytime soon, and it's going to be well into next year.
Yeah, but the stock market's ahead of the general economy. So wouldn't you begin to see some kind of upside 6 to 9 months ahead of everything else?
Well,
in the market?
Usually that's the case, Trish, but the key is we're 2 weeks away from getting into first quarter earnings, and nobody's talking about it. And I think when these reports start coming out, they're probably going to be worse than expected. And the bottom line is earnings are going to drive confidence. They're going to drive stocks going forward or going lower.
Jeff Sott, I've got one that's going to be much better than expected. We got to put in this FASB change. It's going to be relevant for the first quarter. FASB is saying when you're dealing with the toxic assets in distressed markets that have no breadth, depth, and resiliency, there's no trading, don't use it. They're now going to say use a discounted cash flow model. And guess what? Most of the bank losses in the past year have been non-cash from the phony, fictitious sale of the distressed toxic assets. You take that out and you have a historical cost accounting basis on cash flow, Jeff, you could have one hell of a big rally led by banks and financials, because now we got the jackboot of FASB and the SEC off of the market.
I think that's spot on. That's a really good insight. I think when you start valuing these toxic assets as cash flow rather than comps, then instead of being marked to the market at 30 cents on the dollar, you could get marked to the market at 80 or even 90 cents on the dollar, and I think that is huge.
See, Tom Lydon, I want to say this, 80 or 90 cents, hell, I'll take 70 cents. I mean, I've had guys come on the Cudler Report, and they looked at the mortgage-backed securities, and they say it's being serviced. About 70% of those underwater mortgages, including the subprimes, are being serviced. So therefore, instead of 20 cents on the dollar, as per the old Merrill sale last fall, which was a distressed sale, take it up to 70 cents. You got a whole new ball game. You also have an upward yield curve where net interest margins are soaring. That's what Vic Pandit and Ken Lewis and all those guys were saying. This is a sea change. I don't know why people aren't talking about it on this network and elsewhere. This is the single biggest thing for the stock market right here and now. Look what FASB said yesterday.
Yeah,
I agree. I agree, Larry. However, you know, you have to pick your spots. Here's an area where it's not everything's going down. And one area, the regional banks didn't really get caught up with this toxic loan situation.
And you like them, right, Tom?
I think there's some great ETFs that represent the regional banks. They've done very, very well. They've been the baby that's been thrown out with the bathwater here. And when this thing does rebound, and they've done very well lately, I think they're going to bounce back. Also, I know you're a big fan of China. The stimulus package is kicking in. Most people don't realize that China isn't in a recession. They're going to have 6 to 8% GDP growth this year. I think even after the 60% decline off the high, China's looking great as well.
I'm not allowed to comment, so I'll only say that China treats its capital better than we do. But I'm not allowed to comment, Trish. I'm out of here, Melissa.
We're supposed to wrap it up here.
I'm prohibited from commenting on that.
It's a good point. Sorry. All right. Thanks, guys. On that note.